Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. And super excited to have on today's episode. You know him on Twitter, over 96,000 followers on Twitter, Dividend Seeker. I believe it's at dividend underscore dollar.
That's correct.
Welcome to the program. Mark, I'm going to throw it over to you to give yourself an introduction.
Dave, thanks for having me. As you said, I am a dividend seeker, but most folks call me Mark. I live here in the Southern California area. I've been investing for well over a decade now. Obviously focused on dividend stocks and building passive income and really trying to help teach others how to do that and reach their financial goals. I've built my own business, so I do this full time now. And I've built a social media following both on Twitter, YouTube, Instagram, and then I have a weekly newsletter that goes out to folks called the Dividend Investors Edge. And that's really just recapping the market each and every week, looking ahead, and then kind of highlighting key dividend stocks that are either in the news or going through earnings, as well as putting my portfolio out there also. So you can find that over on Substack. That's the Dividend Investors Edge. So Dave, thanks for having me. Super excited to talk dividends.
Yeah, definitely. And again, thanks for being here. As everyone knows, I'm in Canada. It's a lot colder here today than I'm sure Southern California is. I checked the weather this morning. It was minus 12 Celsius and said feels like minus 20. So I'm
Wow.
not sure what that converts to Fahrenheit, but it's cold.
Yeah, it sounds cold.
um, so yeah, let's just get into it. Like I said before we started recording, just like to kind of hit on different sectors and any companies in those sectors that you like or dislike. One of my favorite sectors is REITs, and every single past American guest I've had on the Passive Income Podcast every single one of them owns Realty Income, ticker symbol O, and I'm guessing you do as well. So let's dive into REITs and even that company in particular.
Yeah, so REITs is it's been a passion of mine. It's something that I kind of carve out roughly 15 to 20% exposure in my portfolio. So it does have a sizable place in my portfolio. It's great. It's a great way to get involved in real estate investing. Kind of a hands-off approach. You're investing in a business. So for those that don't know, a REIT stands for a real estate investment trust. There's a key set of rules that you have to follow in order to be considered a REIT. And if you do follow these rules, you will not get taxed at the corporate level. So key things include you need to invest 75% in real estate related activities. So buildings and stuff like that. You need to derive 75% of your income from real estate related activities like receiving rental income. And then you have to pay out 90% of your taxable income back to shareholders in the form of dividends. And this is really the key and why you see a lot of REITs that have higher yields. There's a great way to add yield, add income to your dividend portfolio. So yeah, Realty Income is really the gold standard when it comes to REITs. It's that the monthly dividend company is what they've coined themselves, and folks really like that monthly dividend. The thing is, they tend to trade at a premium within the net lease REIT sector. So I do own Realty Income, and they trade right now. Looking at it, they have a current yield of 4.5%, and I've been kind of talking about it either on articles I write or on social media. Is that 5% threshold for Realty Income has really been a key spot for me to add. It's really been a solid place. So anytime that yield gets around 5%, so we're at 4.5, we're getting close, is really a time to add. But they have a great management team. I've interviewed the CEO over there on multiple occasions. A great portfolio. The tenants, it's in demand. They have great portfolio products, and they're able to turn a solid dividend year in and year out, and month in and month out.
Right. Yeah. And that's exactly so you mentioned a couple of great points there. Having that exposure to real estate without being the landlord, that's one of my favorite things about REITs. I don't have to
Absolutely.
deal with the headaches of that 2 a.m. phone call that something's gone wrong. I don't have to deal
Right.
with hiring a property manager, all of those things. And I believe what you mentioned there for the rules for REITs, they are more or less the same in Canada. I would have to dig into that a little bit to see if there's any differences. There probably are some differences, but I
Sure.
do know that it's more or less the same of, you know, paying out the 90 or 90% plus whatever it might be to the shareholders in the form of dividends.
Yep.
And again, yeah, most of the REITs, I think all the REITs I have in my Canadian portfolio, all are monthly, uh, pay monthly, which is very nice. And I get it. I mean, it doesn't really matter if it's a 5% yield and they pay monthly or quarterly. 5% is 5%.
Sure.
But at the end of the day, I just like seeing that come in every, say, 30 or 31 days, right?
Right.
That's just sort of, I guess, you just like to see the money show me the money, right?
Yep.
I just like to
Right.
see it.
Exactly. Exactly. That kind of allows for that the power of compounding to kind of get moving a little bit quicker instead of waiting quarterly. You're getting every month. To me, it's like you said, it doesn't really matter over the course of the year. They might have a minor impact, but there's a whole list of things that we look at when investing in REITs, and the net lease REIT sector is kind of one of my favorites, and that's exactly where realty income is they invest in these properties, they become a landlord, but they push a lot of the landlord costs over to the tenants. So you think of things like, at least here in the US, you think of things like maintenance costs, property taxes, and stuff like that is all passed on to the tenants. So they're really just buying these properties, sitting back and collecting a rent check. There are some obviously minor operation stuff that they have to do, but within the net lease REIT sectors, they really just lease these things out and push a lot of those costs over to the tenants.
Yeah, that's awesome. I can definitely see how realty income is attractive to American investors and Canadian investors as well. I Canadian investors obviously that invest in US. There are a lot of us that do. Currently, right now, I don't, and the primary reason is the exchange rate. It's not favorable to Canadians right now. It is very
Yep.
favorable to Americans going the other way if there's Canadian companies that Americans might be interested in.
Yeah.
Um, Anything else on REITs before we move on to another sector?
I think there's just a lot of great sectors. A lot of people do, kind of get caught up with realty income, but the thing with them is they do tend to trade at a premium to the market, or a premium within their sector. Before I'd really liked Store Capital, and they got bought out, so they're being taken private. So I've kind of had to find other places to kind of move my money. And actually, my largest holding for the past year has been Vici Properties, VICI, and they're actually the largest landlord on the Las Vegas Strip. They had a solid year this past year. They were in the green by, I want to say, 6% or so, just on stock appreciation. Plus, they pay a 4% dividend. So total return wise, you're getting 10% on the year when the S&P 500 was down 20%. It's nothing to write home about on a regular year, but I'll take that all day in 2022. That brutal year we just saw. So, they have very long-term leases, master leases, and with great operators. And their properties include like MGM Grand, Caesar's Palace, the Venetian, New York, and the list goes on. And if
Right.
if you've been to Vegas and you go down the Las Vegas Strip, there's not too often you see a vacancy sign on a major hotel. So it's a high
No.
barrier of entry for other folks to get into. Is there any more land on the Las Vegas Strip? No, not really there. So they really have that market handled. And the leases, again, like I was saying, is they have, I think their weighted average lease term right now is 39 years or so, in the high 30s. So that's a
Wow.
solid, consistent cash flow that people can see. And again, people are talking, okay, well, Mark, there's a recession coming. How much are people going to go to the casinos? Well, when things get tough, there's a couple things that gambling goes up because people are trying to earn some of that money back. And you see, other things, which I'm sure we'll get into more of this consumer area, is something like Altria. Smoking rates go up as well. It's an
Right.
unfortunate thing when times get tough, but again, with Vici, if the casino operators are doing poorly, they're just worried about them paying a rent check. So it's not whether their people are winning or losing at the casino, or as long as they continue to pay. And all through the pandemic, it was one of the only REITs that continued to collect 100% of their rental income. So, even realty income dropped down to 80%, where they had some tenants that weren't able to pay. Vici was at 100%. It's a consistent, they work with great operators, have great properties. They're newer to the markets. They've only been a public company for, a handful of years or so. So definitely a name to look at there as well. And there's other, I can go on for hours about REITs. I really like the sector and different subsectors within there as well that I've kind of added to recently.
Yeah, that's definitely a very interesting and unique niche that they have carved out. The Las Vegas Strip, like you mentioned, MGM Grand. and New York, New York. I think the only one you didn't mention was Bellagio, and I'm guessing they might have a piece of that too.
Yeah.
And
Right.
that's just those are expensive, beautiful properties. I've been
Yeah.
there. Like I didn't stay at the Bellagio, but yeah, I've
Yeah.
been to Vegas. I've been to that strip, and it's yeah, it's definitely a spectacle to say the least, right?
It is.
Vegas is quite a unique city,
It
and
is.
yeah, that's very interesting to be able to have that real estate exposure through that REIT. That's extremely interesting.
Yep.
Since you said you wanted, if you have more REITs you want to talk about, keep going.
Yeah, I mean, one I've kind of recently added to, I've written about. I also write on Seeking Alpha. We have a marketplace there that's not my marketplace. I write for one, but it's the largest REIT marketplace there. So we do cover REITs on a daily basis over at Seeking Alpha. But one I've kind of recently added to in my portfolio is American Tower. And data wherever you go now, it's you're likely to, whether you're sitting in a room, sitting around the table, you see the teenagers, the teens, everything, they're always on their cell phones, and the need for more and more data, faster speeds and all that. So that's exactly what American Tower is putting up, these cell towers. They have the small cell nodes and stuff like that, fiber. And it's just they have a ton of tailwinds, with the rollout of 5G. And the thing is, 5G has three different layers, and obviously we're talking about speed. The speed is much faster than that of 4G. But the problem with 5G on the higher speeds there is that the data cannot travel as far. So what does that mean? That is a need for more cell towers. So we used to have these things spread out. Well, now we need them closer together, so we need to add more cell towers. That's going to benefit a company for years to come, because this rollout is still in the early innings. Especially, not only here in the U.S. or in North America, but it'll become globally. A lot of people are still on 2G, 3G, and that's going to catch up and kind of be a tailwind there for someone like American Tower, or another key one is Crown Castle. And the unique thing here, when I'm looking over here at my investor dashboard that I kind of keep up to track all my dividend stocks and stuff, is the thing with American Tower is it's a rare gem in the form of a dividend growth stock. When you talk about REITs, you don't often talk about dividend growth stocks, but
Right.
with American Tower, you're gonna you get a 2.5% a dividend yield, and at the same time, you're going to get strong dividend growth. Over the past 5 years, they have a dividend growth rate near 18%.
Wow.
Usually with REITs, they have to pay out 90% of their taxable income. Well, something like Realty Income is going to be increasing at maybe 5%. I think it's less than 5% per year over the past 5 years. Now here, you're going to get a little bit less yield, but at the same time, you're going to get faster dividend growth each and every year. That's going to get that power of compounding that we briefly spoke about. That's the same path that Warren Buffett took. And low payout ratio, safe dividends. So that's definitely one that my most recent buy was American Tower, which is stock ticker AMT.
Yeah, wow, that's that's a great strategy. Like you said, need more towers for the 5G. It makes sense, right?
Yeah.
They're going to keep building these towers, and yeah, very interesting too, because I want to say very seldom, almost never hear of a REIT that is a growth stock as well. So that looks like a very solid play. I'm definitely going to have to look more into that one and do some more research.
Yeah, definitely. I mean, they were down, pretty solid. That's one of the key things in 2022. Now, the stock was under pressure a ton, but kind of, I'm a long term investor, and seeing, okay, these towers, how they're starting to play out, how management is talking about it right now. So of course, there's the short term, headwinds that we're talking about, and folks will look at interest rates, but over the long term, seeing that dividend grow at an 18% clip, a safe
Yeah.
dividend, a solid dividend. They're going to continue to generate more and more cash flows with, kind of their rollout plan of this 5G. So if you think 5G is still in the early stages, then American Tower, or even Crown Castle, which is kind of the little brother to American Tower, because they're one of the largest REITs, and the most dominant, especially in the cell tower sector. So definitely one to look at there as well.
Cool. Yeah, those are some very interesting takes. Yeah, let's move on from REITs because, like you said, we
Right.
probably both could talk for an hour just on REITs.
Right.
But the energy sector, obviously, some very expected news this past week with Algonquin Power. I'm sure you're aware of what happened there.
Yep.
And any thoughts on Algonquin Power in particular, or anything else in energy, utilities, oil and gas, in that sort of whole general field?
Yeah, I wish I was in energy all of earlier in 2022 because looking back, I think I want to say they were the only green sector in all of out of all of the S&P sectors, and it was by a wide margin. So I don't own that one in particular. I've had ExxonMobil for a while, in and out of that, and some Chevron, but overall, my energy exposure is through ETF. So just
Right.
I have a mid-sized position in the XLE. So, something energy's had a heck of a run. It's still something that I think, a lot of folks are looking to stay safe. It's a safer spot. You're going to get a decent yield. There's a lot of energy issues over in Europe, especially, that have been well documented as well. So, my
Sure.
exposure has been through XLE.
Interesting. Yeah, yeah. So yeah, well, Algonquin Power is a Canadian company, but I know they have quite a bit of exposure in the U.S. as well, and I
Right.
believe they also trade. They obviously they trade on the TSX, Toronto Stock Exchange, but I believe they have a ticker on the New York Exchange as well. And yeah, they it was very expected this week that the dividend was going to get cut, and hopefully that helps right the ship. And I guess we'll just see where it takes us in the future. I do hold a small position in AQN, and I just plan on holding it for ever, right? Like,
Yeah.
um, and I did put out a tweet a couple days ago, it might have just been last night, saying, right now everyone is fearful of Algonquin Power. It is now the time to be greedy. And it kind of got a mixed response, obviously, right? That's what you get.
Yep.
So I don't know. What do you think? Is it the time to be greedy or is it time to be fearful on that one?
With me, when I'm kind of investing in whatever investment, whatever stock it is, it's kind of, going in with a strategy and a thesis. And if that changes, a dividend cut is big for me.
Yeah,
That shows that, obviously the operations are struggling, and I'm not as familiar with their operation, looking at the financials and stuff like that. But if the thesis and the direction has changed, if the cash flows are going the wrong way, to where trying to see what can the company do to turn things around in order to, one, get this dividend back rolling again,
right.
because dividend stocks, that's especially higher yield. If you're looking at higher yield dividend stocks, that's a key reason that folks invest in it. It's for the dividend. I tweet out all the
Yeah,
time, don't invest in yield alone. But once you get closer to retirement, you are looking towards these higher dividend yield type stocks. So if it is a dividend cut, that was one reason I got out right before, was on something like AT&T. They went through the dividend cut. They were continuing to show struggles. I was, to put it frankly, disgusted with the management team. It was just bad acquisition after bad acquisition, mountains of debt. Now they've spun off, a part of their media business. So hopefully they can kind of turn things around a little bit. But
yeah.
just seeing that, and how the thesis on why I originally invested in AT&T, and I think I got out around $32 or so, that was just completely gone, and just I completely lost faith. So a dividend cut would be something that where I would start to lose faith and have to definitely second guess and look deeper into what's going to turn things around. Is there a catalyst higher, I guess.
So major red flag for you is what you're saying.
For me,
Major
yeah,
red.
it
And
would
I
be.
get
Yeah.
that. I get that 100%. Yeah,
Yeah.
totally. So you mentioned AT&T and T and telecoms, telecommunications is another sector that I do like to discuss.
Sure.
Um, Several of my past podcasts, I've noted that it's one of the few sectors that is very similar. Whereas in Canada, we have sort of three big players being Bell Canada, TELUS, and Rogers. And in the US, kind of same thing, three big players being AT&T, Verizon, T-Mobile. And then
Yep.
obviously there's some smaller players as well in both countries, but very, very similar. You just have these kind of big three, control the market more or less, and not quite a monopoly, but pretty close, right? So,
Yeah.
any further thoughts on telecoms, telecommunications, and well, they're now, like you mentioned, and media companies, right? So they're
Right.
beyond just telecoms or telecommunications and media.
Yeah. No, yeah, like you mentioned, it is the big three: Verizon with stock ticker VZ, AT&T, as we kind of just discussed, and T-Mobile, which is, that one's kind of been growing at a much faster clip than all of them. They don't pay a dividend stock, so we won't discuss them. But in terms of growth, they're right there.
Right.
I think Verizon's kind of the cream of the crop there. Looking at those other two, or even all three, really, they have to me, a little bit much stronger balance sheet. Again, they do have high debt as well, But
Yeah.
going back to what we were talking about again, not to bring it back to REITs, but when we're talking about the telecommunications and all that stuff, when you're looking at these three, they're battling it out like crazy to get these customers. And you see them again going back to the old ways of subsidizing phones. Come get your iPhone free by switching over to Verizon or AT&T, and it's all,
Right.
we're going to give you 750. I turned in one of my iPhones. I've had an iPhone for 3 or 4 years of the past version, and I think I got like $700 for turning it in, and got a brand new one for just a couple $100. And it's just wild how they're doing this. But I'm like, okay, well, they're battling it out so much, it's going to impact margins moving
Right.
forward, at least in the near term, for however long they're going to battle this out. Why not just invest in the infrastructure behind all this? What makes everything tick? You need self towers. So it goes back to American Tower or Crown Castle. So that's what kind of another thing that had me invest in American Tower most recently.
Nice. Yeah, no, that's a very sounds like a very smart play, right? Because like you said, yeah, invest in the infrastructure and not the companies that are literally just like, you know, gladiators, battling it out,
Yeah.
trying to outdo their opponents. So,
Right.
and it's very similar here in Canada as well with Bell and Telus and Rogers, all very similar, trying to win customers over any which way they can. So,
Yeah.
moving on from telecommunications, and that another one of my favorite sectors, and most Canadians, is the banking and financial sector. I'm sure you probably have some knowledge and opinions of the Canadian banks. Let's start there.
There's a lot of them, and a couple of my other, I have a couple, Canadian friends on Twitter that I speak to, or a lot. You have yourself on there. Stephen Wealthy is in Canada as well. He'll talk about Canadian stocks, and then the Alpha Thought. He always puts out
Yeah,
a lot of the bank ones, and so the yields are solid, and they're very well run businesses as well. Kind of when you kind of compare those major three or four to the other ones over here. And I'm bullish on the financial sector myself. REITs kind of used to fall under there, but now it's really, they've carved that piece out within the S&P 500. So when it comes to banks, I was actually out yesterday, but I kind of briefly got to see the emails and the summary reports, but was looking forward to diving into the key metrics and stuff like that for JP Morgan, Wells Fargo, Bank of America. But when it comes to what I own, Bank of America is my largest holding in terms of banking. It's not my largest holding, but
yeah,
when looking at the financial sector, Bank of America is very primed to interest rate moves. So when interest rates move higher, the bank that gets the biggest hit, and not hit but benefit, is Bank of America. They're the second largest here in the U.S. in terms of assets, trailing J.P. Morgan. Those two, just the leadership team of Jamie Dimon and Moynihan over at Bank of America it's solid. How that company has been turned around at Bank of America, and just seeing the key with financials and banking is looking at that net interest margin, which is really the difference of how much is a bank earning from loans. If you have a mortgage with them or whatnot, compared to how much they're paying back out for you if you have a savings account, which usually if you have a savings account with one of those major banks, it's like 0.002, and you get your 11 cents per month, which is just pathetic.
if
So I've
that.
kind of moved out a lot of my savings and emergency fund out of my main banks. And, I go to something like I have it's called Marcus by Goldman Sachs. And you get, for when you get started, you get a 4.3% high yield savings account. So that one's been, a solid place for me to move some cash, because you're not getting a ton over at the major banks. But then you think about it, okay, well, that net interest margin's got to be, pretty solid, because, rates are continuing to go up. We're going to get another hike here shortly from the Fed. And, I think it'll be around, 25 basis points is kind of where folks are looking. So as that continues to climb, it's just going to continue to be a tailwind for
Yeah,
these banks. The key though is going to be looking at the strength of the consumer, because if the rates keep going up, but then unemployment starts turning around, which it hasn't yet, the labor forces remain quite strong. That's when you have concerns, because you can have higher rates, but if folks can't pay their loans, then that's when you have to dip into reserves. But Bank of America, JP Morgan, Citi, Wells Fargo have already, and along with the Canadians, Canadian banks have already increased their reserves. So they're kind of preparing for it a little bit. But, a lot of the stuff we've seen from consumers is the consumer continues to hold up quite well. Things to look at is during, the pandemic times is how much folks were able to save up. And the savings rates just went through the roof because everyone was just stuck at home. So, they weren't
Yeah.
spending a ton of money going out to eat or doing entertainments or, going to the bars on a weekly occurrence or monthly occurrence or something like that and just kind of blowing money. Or even Disneyland for that matter, because they
Right.
were closed for forever. So,
And pro
um,
sports too, like you can spend a
right,
lot of money going to a hockey game or a baseball game or a football
yes,
game, and they were all of a sudden that wasn't an option. You're not
right.
spending that $200 or whatever it is to go to a game.
Exactly, yeah. So those rates just went through the roof, and folks were able to save. But now what you're looking at is that has all been depleted. That's gone now. The inflation has had a huge impact on that. When you're paying, I don't know what it is over there where you're at, but here in Southern California, we got up to mid 60 or $6.50 plus on gasoline. So we go from maybe $3 a year before that up to 6.50 is a
For a
big
US
impact.
gallon for my Canadian listeners.
Yes, yeah, US gallon. And so that is gone now. So I think, in terms of how much the US consumer at least has been able to save, and I would
Yeah,
assume it'd be the same over for the Canadians as well. And so just watching that strength of the consumer, ensuring that they're still able to pay their loans, that's going to change my viewpoint on the financial sectors. If we start seeing unemployment increase a ton, if we get a moderate to bad recession, then the banks are gonna to struggle there. So it's kind of you're teetering on things there.
right.
But if we're able to have a mild recession like a lot of folks think, I think the banks in the financial sector in general can do quite well.
Yeah, a couple points there. There were a lot of places in Canada where the gas price was well over $2 per liter. And so to do the math on that, you multiply 1 liter by 3.78 to get a US gallon. And then you would have to convert Canadian dollars to US to realize how much to make the actual comparison. I'm not going to do the math right now. I can't do that math in my head. But basically, yes, gas got extremely expensive here as well. Just my one final thought on the Canadian banks. I don't know if you know this. I'm just going to say this for you because you may or may not know this. The Canadian banks have all been paying dividends for well over 150 years, and coming up in 6 years' time, in 2029, I believe it's Bank of Nova Scotia that will be the first to hit the 200-year anniversary of paying dividends. They started paying dividends in 1829. Bank
Wow.
of Montreal started paying dividends in 1831. So in 8 years, they will hit a 200-year anniversary. And yeah, so it's just extremely impressive that they've been paying dividends for that length of time. I've even
Yeah.
joked in the past that like we need to come up with a name for that. Like, and somebody actually did come up with I thought it was a really good name called like instead of, obviously dividend kings and aristocrats, they said we should call them dividend centurions. And I'm like, yeah, that actually
I
makes
like that.
sense.
I like that. That would
Yeah,
be great.
cool.
Yeah,
So
I actually did not know that. I think here the banks that they went through when we went through the Great Recession, a lot of them had to either get bailed out or
yeah,
or see a dividend cut. So I think Bank of America is only at like 9 years or so. I don't recall what their exact dividend, how long they've been able to increase dividends for. Yeah, they're at 9 years right now. So
yeah.
big difference.
I'm not saying they've increased dividends every year for 200, but just paying dividends
Hang
for
on. Yeah,
200
got it.
years is, I think, is impressive on its own, right?
It is. Yeah, exactly.
So
That's a good little nugget there. I like that.
yeah, there's actually a great tweet that I had before from at Settling Nomads that listed all five or six of the Canadian banks and the years they started paying. And yeah, so the big five, I think Royal Bank being the youngest at about 155 or 165 years as well, right? So it's just yeah.
That's impressive.
I'll find that tweet and DM it to you because
Yeah,
you'll be
definitely.
interested in it.
Yeah, definitely.
Another sector I'd really like to discuss is consumer staples and consumer discretionary. There are so many great U.S. companies that I would love to invest in. The consumer staples like Walmart's, Costco's, Pepsi, Coca Cola. People are going to use. People are going to shop at Walmart. People are going to shop at Costco. People are going to drink Coke and Pepsi, and
Yep.
yeah, those types of companies just look extremely attractive to me. So, um, yeah, I guess any thoughts on any of the companies I just mentioned or anything else in that sector?
So for the ones that you mentioned, Coca-Cola is one I own. You know, I've done some YouTube videos comparing. It was kind of a fun one, kind of comparing Coca-Cola and Pepsi. You know, the two giants within the beverage space, and you know, Pepsi's got a lot of folks like Pepsi due to the fact that they have the snack side of things.
Right.
But you know, they're both pretty safe investments, especially when you're going through times of a pending recession, or some say we're already in a recession. The thing with Coca-Cola is that the management team, the CEO James Quincy's done a nice job, kind of changing the company a little bit. Whereas they got so broad on, they wanted to have so many different types of beverage products. He said, okay, hold on, let's bring things back in. Let's look at the things that create the most margin for the business, rather than quantity. The number of products isn't always great. It could be a bad thing as well when you're trying to create so many different products. Let's just focus
Yeah.
on the key products here. So he brought the number of SKUs down, the higher margin SKUs. But then not only did he do that, is he's kind of changing the packaging a little bit. You used to have these 3-gallon jugs of Coca-Cola. Well, now you can get, if you just want a little sip of it, because we're
Yeah.
all, obviously it's January, so everyone, well, it's the 14th, so some of our New Year's resolutions for eating healthy probably might already be over. But because for me, it doesn't usually last all that long. If my daughter or son will come out with a scoop of ice cream or something, I'll want to take a little nibble there and have my cheat day already. But I think the way they're kind of getting creative with having these small cans and medium sized cans, and then you have your
Yeah.
regular can. It's a way for people to go, okay, well, I can still have it's just a small one. So I think that's a great way that they're kind of evolving there. Pepsi obviously has got the snacks with all the different chips and snacks, and as well as the beverages and teas and everything. So that two well diversified companies. The Staples is one that tends to do well. The sector as a
Yeah.
whole. Walmart
People have
is
to eat, whether it's a
you do.
recession, whether it's a
Yeah,
bull or bear market, people have to eat every day.
exactly.
So that's why I really like those types of um, companies and this sector in particular.
Yeah, definitely. I mean, Walmart's the largest, has the largest market share in terms of, for grocery. Costco, I think, is one that you had mentioned there. We go
Yep.
to Costco on a couple times a month, and you can kind of get lost in there. But I think they're doing a great job. Very small yields, so you're probably not investing in Costco for the yield right now. You're going to get that strong dividend growth. Although, but if you're looking for higher yield, Costco's probably not the name for you. But it's a solid business with their renewal rates are well above 90%. They're going to continue to hike those. You can get your $1.50 hot dog, and you
Yeah.
can't complain about that. So, but yeah, there's a lot of good names over there. Target's a name that I've kind of been teetering on, that I kind of want to pull the trigger on to add to the portfolio. Just they've gotten just crushed.
Right.
That a lot of these consumer names, especially if you start getting into like retail, though, it have been even more just due to the retail component of inventory. We went through this supply chain issue where we didn't have enough inventory, and now we have too much inventory. But if you're looking at a couple there, it's the Walmarts, Targets, Costco's, Procter and Gamble's another one. You're still
Yeah.
going to wear clothes and need to clean them and all that stuff. So along with their array of different products. So a good sector to look at for safety there, and
For
a
sure.
decent dividend yield. But you could always look at the ETF as well. So a lot of
Yeah.
great options.
Do you know the Target story in Canada? What happened to Target in Canada?
I do not.
So I'll make this as quick as possible. So basically, Hudson's Bay Company is one of the oldest companies in the world. I think it was incorporated in like 1640. They had a subsidiary company called Zellers. Zellers was a discount department store right across Canada, 120 or 140 stores, and very similar to a Target. So basically, Hudson's Bay Company, the parent company, eliminated all the Zellers, and just that was the end of Zellers. And then Target saw all of these stores sitting there empty in Canada and came in, and with this huge like expansion right across coast to coast, right? And yeah, they lasted I think less than 2 years. They didn't
Wow.
did not catch on in Canada. I'd have to dig deeper into all the reasons why, but Yeah, they were a flash in the pan in Canada for about 2 years, that's it.
Wow.
Yeah.
Interesting.
And
Huh.
as an American who like, every American goes to Target probably once or twice a month, right? And just
Right.
would think, "How could that ever happen?" So, but yeah, it happened here, and I don't know if just maybe they weren't marketing correctly to Canadians, I'm not sure exactly, but yeah, they were in and out real fast, so
What would be the premier, you know, it, for how you say we go here to Target once or twice a month? What would it be out in over in your area?
well, for me personally, it's Walmart.
Yeah, okay.
It probably is Walmart for most people. Um,
Okay.
we have other grocery stores that are like discount grocery stores. There's one called No Frills, it's very popular, but they are just a grocery store, whereas with Walmart, you can obviously buy a whole bunch of other stuff with your
Right.
groceries as well, so, yeah.
Got it.
I think that probably was also part of Target's problem is Walmart was already established in Canada, and they were having a hard time competing.
Oh, okay. Yeah, that could be.
So, like I said, I wanted to make that story as quick and
Yeah,
painless as
that's interesting.
possible. Oh, wow. Technology, another sector. You mentioned iPhones there before, and yeah, there's some obviously more great American companies in the technology sector. I always mention Tesla as a technology stock more than a car company. So
Sure.
you've got obviously your Apples, your Microsofts, Tesla, and more in the Silicon Valley. What are your thoughts on technology?
That is a battered sector right there, but it's hard because I don't think it's one that you can kind of turn your back on just because there's so much potential. And again, going back to being a long term investor, is trying to poke. I haven't made any investments in technology companies in a while, but I do own a fair share of the Apples, the Microsofts, Alphabet with Google.
Right.
Those are kind of my largest three. Did have a little bit of Tesla for a while, and kind of right after the Twitter stuff. So I kind of joined the roller coaster, the elevator down for a little while. But I just think he's got Elon's kind of driving that thing down right now. Not only selling a ton, but focusing on Twitter when Tesla is kind of just what's the plan here?
Hmm.
They're having to slash pricing. Especially in December when here in the states they're gonna reintroduce, or they already have now, the what is it, the $7,500 credit that you could get. Well, that kind of ran out for a number of years for Tesla because of how many, it was based on the number of cars that you sold. Well, folks were like, okay, well, that's coming in January. Why would I take delivery of my car in December and not get that? Well, they ended up slashing prices to try and help folks and try to get some of these cars out of the way. But I think they're still well ahead in terms of technology, and that's they're a
Yeah.
great car to drive. I don't own a Tesla, but I've driven a couple of them, and neighbors have them. They're around. They're all over the place out here in California, especially
Yeah.
Southern California, all over the place. I mean, you see there's I think there on my street alone, there's probably 12 of them. There's a group of friends that hey, let's all go. They all got Teslas at the same exact time, same color, same model. I was like, "Oh, okay, but
I
they're
feel
they're
left
all
out,
over.
guys. You didn't tell me.
Yeah, right. So they're literally all over the place out here in Southern California. But in terms of my favorite technology one, it's probably close between Google and Microsoft, but I'll probably give it to Microsoft just because of the diversity there,
Yeah.
diversification within their portfolio, especially with this Activision thing coming on. Hopefully that gets pushed through down the road here. But with gaming, you're going to have they're obviously a huge cloud player with Azure. So gaming, and then you have the Windows operating system. You have the Office 360, which has moved over the years more into a subscription model. So
Yep.
they just have a lot of things going for them. Apple's obviously great, but you could have some issues with iPhone sales. It's been a nice wave. People have been talking about it for a while, also, and they've just continued to prove others wrong. So it's harder for they're going to have to continue to create new products that get consumers excited. So trading at a multiple that they had been over 30 is tough. But obviously a great company. But if I'm going to choose one, I'd side a little bit more with Microsoft.
Yeah.
again, not like we talked about previously with someone like Costco, is you're not going to get a ton of yield. I think, Microsoft's a little over 1% right now.
Hmm.
Apple is below. Both of them have dividend growth rates around 10%. So that's nice. Low payout ratio. So the dividends are plenty safe.
Yeah.
Both companies have strong cash flows, but I think we're gonna, at least in the near term, is continue to have some headwinds from economic. But I think the thing to remember as an investor is, with the stock market, it's usually 6 to 9 months or so, looking forward. So when the economic data starts to change, and maybe we do go through a recession, but when the economic data starts to change and we start getting back into growth mode, the stock market, generally speaking, and going through history, should already have moved and started moving higher as well. So something to think about that as well. Now, my magic 8 ball doesn't really work anymore on when that's going to be exactly, but
Right.
just something to consider when you see, some of these high quality growth stocks that have been, especially in the technology sector, that do continue to generate strong cash flows, is to maybe nibble here and there and take that DCA approach from there. So
Right. You mentioned the possibility, potential of iPhone sales dropping off, and I immediately thought of BlackBerry because I'm sure you remember, 15 years ago, everybody had a BlackBerry,
yeah,
and
right.
and and where are Blackberries now? Nobody has a
Right.
BlackBerry. So
Are they? I don't know the answer to this, but is BlackBerry even still because there's a building down here in Orange County, and on the top of it it says BlackBerry.
yeah, so BlackBerry is a Canadian company as well, and back in the day, it was actually called Research in Motion, and the ticker symbol was RIM, and obviously it shot way up when Blackberries were all the rage. And then it dropped way down when
Yeah,
basically when iPhones came out and just destroyed the BlackBerry market share, right?
yeah.
And so they're now their ticker symbol is BB, BlackBerry, and they have moved into more of a I think they do security software and more of a software type firm. So they are still in technology, but they don't make phones anymore. Yeah, it's interesting.
That would have been a I think that was prior to the the Reddit Wall Street Bets one, but that would have been probably a great meme stock for those folks.
Yeah, exactly, exactly. That was back in the day before meme stocks were a thing, but
Yeah,
yeah, for sure. And there's still tons of people that, buy BlackBerry at $8, sell it at 14, buy it back at an 8 or 9, sell it at 12 or 13, and do
yeah,
that all day long or all year long, right? So,
yeah. I'm looking at it right now. I mean, they still have a market cap of $2.2 billion. I
right?
mean, they're
Yeah,
trading
so there's
below $4 now, but
well, yeah, sorry, $4 US, you're probably looking
right,
at
yeah,
it
yeah.
a US
But yeah, they're
dollars,
down.
so
Yeah, yeah, yeah. I
which is
always
still
saw that
probably about
building there.
6,
I'm like, man,
650 Canadian.
got
I
it.
haven't looked at that stock in quite a while, so I was
Yeah,
going by what it was trading at, say, 6 or 8 months ago, probably the last time I actually looked at it.
yeah. That's wild. Interesting.
Another the last sector that I kind of always bring up, especially with American guests, because it is 110% different between Canada and the US, and that's healthcare. Whereas obviously healthcare in the US is very much insurance based, and Canada obviously has universal healthcare, so there's sort of different ways to play the healthcare market in Canada. And you had mentioned, oh, actually, no, you mentioned Procter and Gamble, but Johnson and Johnson was the one I was thinking of, which obviously some people can think of as a health, healthcare stock company.
Yep,
Um,
absolutely.
so what's your thinking in healthcare?
So I recently on my YouTube channel did a top 5 ETFs video, and I kind of talked about, it was more 2020, it was for 2023, so near term looking, but this can also be long term for this sectors, because healthcare is something that's always there. But and one of them was this healthcare sector, and looking at the XLV, which is the Sector Spider Healthcare ETF that you can invest in, low cost ETF, got great holdings in there. Johnson Johnson is the number one holding. Johnson & Johnson happens to be my one of my largest top 5 positions in my portfolio. It's something that I've held for a long time. It's just something that I continually add to, and they're going through a lot of change right now in the fact that they've been this company for over 100 years, and they've grown so big. They operate in three different segments. You have the consumer health segment, You have the pharmaceutical segment, and then you also have they call it the med tech or the medical device segment now. What's happening is this consumer health one is spinning off. All three segments have gotten so big within the company that they want to focus and kind of create more shareholder value by, hey, if we break off pharmaceutical and the medical device, which is a faster growing segment for the business. Pharmaceutical is their largest one segment as a whole. But if we can break those off and focus more on those, we can continue to grow those, maybe even at a faster clip. Whereas the consumer health is more of that safety blanket for the company. That's where you're going to find your Tylenol, Listerine, Motrin, Zyrtec, Band-Aid. The list goes on.
Right.
And whether it's sunny or rainy outside, whether we're in a recession or not a recession, it's growing or slowing, we need these things. Your headache doesn't care what's going on out in the world today, or if your kid, skids their elbow or their knee, you still need Band-Aids. And these products are in need regardless of what, the economy is doing. So that's where that safety blanket comes in. So at the end of this year, they're going to be spinning that out, and it'll be called Kenvue is what the new company is going to be called. So I'm thinking it's going to take shape a lot like, I'm hoping, a lot like Abbott Labs and AbbVie did. AbbVie took on the pharmaceuticals. That's a stock that I've loved in this sector as well for a number of years. And they're in the XLV or their healthcare ETF as well. And I'm hoping it's going to look more like that, whereas the pharmaceutical branch kind of spun off, and they called it AbbVie, and Abbott Labs focused more on their stuff. They had medical devices as well. So, I think that's going to be an interesting component to see how the dividend plays out. But, healthcare as a whole is a pretty safe. It's kind of looking expensive right now because a lot of people are positioning their portfolio more defensive right now. And healthcare, and we already talked about consumer staples, are two of those areas that folks are really looking to, put more money. So, Johnson Johnson, AbbVie, United Health, in terms of insurance that you mentioned over here. So there's some good companies to look at there and kind of just add to on a regular basis.
So do you think that when they split, I believe you said it was going to be called Kenvue, and you have a large portion of J&J in your portfolio, will there be a stock split of some sort that you will end up with some of the Kenvue?
Yeah, so we're supposed to get two shares in both of them. How the dividend plays out, I don't think has been kind of communicated, or how if that will be anytime soon. So the clarity there has been a little foggy, but yeah, we'll have positions in both companies.
Interesting. So I'm going to tell you, and you're going to love this, how I play the healthcare sector in Canada. Again, because we don't have the insurance based, we have universal healthcare. So the way I play the healthcare sector is by REITs that own medical properties. So I have one called Northwest Healthcare, and they own like the actual doctor's offices and medical clinics and those buildings. I have another one called EXE, where they own like the long-term care and retirement homes. So right back, full circle, right back around to REITs.
Right. Exactly. Yeah, that's obviously a great sector. One I've kind of, one that's been under pressure, and it's been, I'm sure you've seen on Twitter a lot, has been Medical Properties Trust. They're a REIT that owns hospitals. They're a pure play hospital REIT. I had owned that one for a number of years, but it's at a 9% plus, I think, dividend yield right now. So it's kind of been, the risk has gone up a little bit. You have too much exposure to one single tenant, and I just felt like the data that they were able to put out, it was kind of secretive, and a lot of questions are always being asked about the stability of this single tenant. And it's your single largest tenant, and it's not, you can have large, like someone going back to Realty Income or something, their largest tenant's going to account for like 3% or something of their annual base rent. But this one was a large one, so that one was kind of that kind of gave me some pause. But I don't know if you've looked into. There's one stock ticker DOC, and that is Physicians Realty Trust. You got Omega Healthcare, Welltower as well, or some kind of U.S. based hospital, or not hospital, but medical REITs to kind of look at.
Right. Interesting. No, I haven't looked at that one.
But yeah, that
so before we
one is similar to what you were talking about, how they have the medical office buildings and doctors, outpatient type stuff.
Before we wrap up, I just wanted to share some screens here. So you mentioned your newsletter off the top, and I just wanted to give that a shout out here. The Dividend Investor's Edge. Anything you'd like to add to?
Yeah, so if you're not a subscriber, you can subscribe to the free version. You just go to russinfinancial.substack.com and you can find our newsletter there, or you can just go to substack.com, type in the Dividend Investor's Edge. It's the number one dividend focused newsletter on Substack. We write there each and every week, just kind of recapping the stock market, focusing on dividend stocks. We'll kind of look at some key analyst upgrades or downgrades, any dividend news. But we also talk about the stock market in general and just kind of recapping there, look at some key dates that are coming up for investors, and just to kind of, recap everything all in one spot and do all that. So we also have a premium subscription where you can see my exact portfolio. I do monthly portfolio updates. I also do these deep dives. So that's one that just came out. It's a brand new format. So, a lot of folks, I got a lot of great feedback on this new format, kind of breaking down, and it was on Johnson & Johnson, which we just spoke about. So that was kind of a good segue there. So just happy to kind of just connect with folks there, and would love to have you join.
I will do my best to link these descriptions or put these links in the description below. I will try my best to remember. I do also want to just quickly here bring up your Twitter, and I want to be the first to congratulate you. Is that showing up on screen?
I can see it. Yep.
Okay. I want to be the first to congratulate you on 100,000 followers. I can see you're not quite there yet, 96,000, but someone will be watching this in the future and you will have surpassed 100,000. So that's obviously a incredible milestone. And yeah, congratulations on even just getting this close. And yeah, you'll soon be there.
Yes, thank you. You'll be the first one, but no, it's been a fun journey, just kind of connecting with folks. And like I said at the top, it's just the whole reason I've set out on my whole business in general is to kind of empower and educate retail investors like myself and everyone that kind of follows, and just put the power back into the retail investor, help them better their financial. Be able to meet their financial goals long term. So, I appreciate the time, Dave, and thanks for congratulating. We'll be there soon enough.
Yeah, exactly. And if you don't already follow him, which I'm sure you probably do, but you can find him at dividend_dollar. I'm sure even just searching Dividend Seeker, you would find Mark's Twitter page.
Absolutely, yep. You also find a lot of fakes on there with the Dividend
Oh,
Seeker.
yeah.
I get a lot of those, so be careful of those ones.
Yeah, that's a good point. So thank you so much for coming on this episode of the Passive Income Podcast. It's been an incredible conversation. I've really appreciated having you on. It's just been my pleasure to have this chat with you.
Absolutely, and my pleasure to get on here and discussing dividend stocks and REITs, and just really thankful for the time, and I'm sure we'll chat again.
Awesome. Thank you so much. If you're still watching this late in the episode, you have to subscribe. Those are the rules. You're still here. Hit the subscribe button. Subscribe.